Hello everybody and welcome to Narwhal Capital Management's second quarter webinar. We're going to be looking back at second quarter data from the US and foreign markets, as well as taking a little bit of a look ahead at the third quarter and what we're doing in individual client portfolios here at Narwhal Capital. I'm Andrew Hall, Narwhal's Vice President, and joining me later today is Benjamin Nye, CFA. He is Narwhal Capital Management's Senior Equity Analyst, so he's going to be joining me along the way. Today, we're going to be looking at a couple different things. First and foremost, we're going to be looking at the United States macro picture. We're going to be looking at employment, inflation, data like that you would expect in an economic review. Along the way, we're going to look at some international markets and some factors that we're paying attention to, some things that may be expected, some things that may be surprises. And we're also going to look in particular at the U.S. market itself. What's happening, what's driving stocks, what's going on, and lastly, we're going to look at what we are actively doing in portfolios. To get started, this is a really straightforward, simple chart. This is simply what the S&P 500 has done year to date. Up about 10%, really strong year. It's been kind of interesting to watch this unfold. Obviously, at the beginning of the year, you had the so-called Trump bump and the Trump rally, trying to figure out exactly what the new presidency would mean. We've had plenty of ups and downs along the way, which you would expect in a market. They don't just go straight up. So we've had some volatility along the way, which we'll touch on a little bit more. But in general, a really, really strong market. We had a strong first quarter. We just wrapped up a pretty strong second quarter. Several consecutive years now of up markets and several consecutive quarters. Actually have to go all the way back to 2015 to find a down quarter. As we expand out a little bit and look at this data, not just back to 2015, but way back to 2000, we really see what the market has done recently. And this is a great way to kind of gain some context starting off. Obviously, the 2000s, the early part, that decade was kind of called the lost decade for investors. And it's easy to see why a lot of people felt that way. You had obviously some highs in the early 2000s, followed by some lows and a strong fight back really to where we got back in 2007 and 2008. Only to be followed by the financial crisis and that crash in 2008, extending into the spring of 2009. Since then, what's interesting, though, is really this rally that we've had, and it's really a historically long rally. We are not just getting back to where we were pre-crash, we're actually accelerating significantly past that, as you can see on the chart right here. The other thing that I think really stands out here is just how long we have been marching upward. We've had a few big years of large gains within the S&P 500, but more impressive than that really is the consistency with which we continue to see these markets push and go forward and go up. This is a historically long run. If you look back into the context, it's not very often that you see year after year of up markets. We saw this an up market in 09, 10, 11, 12, 13, 14, 15, 16, and as of right now, a really strong up market in 2017. Coming up now, I'm going to pass the microphone over to Ben Nye. Ben's going to talk a little bit about volatility and some other factors we're keeping our eyes on in the U.S.
Thanks, Andrew. So if you look at the market, obviously a very strong long-term uptrend in stocks, and usually that correlates with a sustained period of low volatility, which is something that we've seen. Now, if you look on TV or read some blogs, what you could hear is that volatility just does not stay this low for that long. And if you look back at the chart, back in the mid-2000s, we had realized volatility on a 30-day basis that was consistently around about 10, but that only lasted for about 3-4 years. Already we've gone about 3, 4, 5 years now with that volatility around 10 and even lower here in 2017 so far, and that calls for a rethinking of expectations about where volatility should be. And a lot of people say that volatility should revert to a mean level, and they say that's about at least 20, and we could be as high as 40, 50, and those wounds of 2008 still ring very true. And to be sure, that is a cause for concern. But if you look back on a longer term history of what realized volatility has done, you do see extended periods where volatility stays and remains below 10 for extended period of time. Now, volatility measures the change in the S&P 500 on a 30-day basis. This should be distinct from implied volatility. Implied volatility is what you see in the VIX. The VIX is often called the fear index, and that's a measure of what people expect volatility to be. But there's a distinction between what people expect volatility to be and historical volatility. And if you look back at historical volatility, you can see we've had long periods of secular bull markets, for example, in the 50s and 60s, where volatility was simply low, and you've had a secular bull market. Now, we could still be in that same period where of the late 90s through the 2010s, but there could be a case to be made that we have now transitioned regimes. Volatility tends to cluster. A good book to read on this is Benoit Mandelbrot's work, and his work with fractal geometry with volatility. And so when you do see that volatility cluster, you could say that periods of low volatility cluster together and periods of high volatility cluster. Now, which period are we in? That's up for debate. But what's not up for debate is that we do have these extended periods of low vol and extended periods of high vol. So in this chart that we have here, we have the cumulative frequency of periods of volatility. So in here, we have identified each data point and allocated it into a bucket. Is it less than 5? Is it less than 10? Is it less than 15, 20, etc.? And what you can see is that 80% of the time, volatility is actually less than 20. So far from 20 being the normal, which is what some would like to say, actually less than 20 is by far more frequent than above 20. And if you go further than that, 2/3 of readings are under 15 realized volatility. Now, we are at low levels of volatility historically, but again, as we've said, this does not mean we are poised for an imminent rise in volatility just looking at this technical data. Now, we're going to talk a little bit more fundamentals, but as far as the technicals go, it's difficult to expect an immediate rise higher in volatility simply on this data, just because not all periods are like 2008. 2008 was abnormal. It wasn't normal. And one of the reasons that you have seen just an improving market and lower volatility and higher stock prices is an improvement in the fundamentals of the economy. Over the last few years, weekly jobless claims, which is a measure of how many people each week go to the unemployment office and file for unemployment, has been consistently dropping. The dotted line on the chart is an average of the last 5 weeks of weekly jobless claims. That smooths out some of the volatility that you get there. And what you can see if you look at that dotted line especially is if you see a sustained downward trend, which is good because it means that fewer people are filing for unemployment, which if the flip side of that means that more people are working. And you do see in 2015 that kind of stalled out a bit between 260,000 and 280,000 for a while. But beginning in May and June 2016, we once again resumed that downward trajectory. And that's important to remember as we go through this presentation. What happened in early 2016 is that the oil prices began to stabilize, and you started to see fewer layoffs from that part of the economy. And for that reason, you've seen a resumption in the downward trend in weekly jobless claims. And it's again, what's important to note is that this was happening even before Trump was elected. Now, if you look at the next slide here, this is the unemployment rate versus the participation rate. And what's interesting to note is that the participation rate is secular. And when we say secular, we mean that's a long-term trend that pervades cycles. Unemployment rate is cyclical, so that goes with the business cycle, and you can see how that trends over the time. So if you look at the participation rate, it's actually been declining since the 1990s. It had a strong rise from the late 60s to the mid-90s, and you think about what was going on at that time. Well, after World War II, people came back from the war and started having children. This was the baby boom. in the late 60s, early 70s, they started to work. So all these kids who weren't working joined the labor force, and that labor force participation rate began to rise. You also had the rise of women joining the labor force. And now that those people are entering the latter stage, the twilight of their careers, you're seeing that participation rate begin to drop. Now, you have seen a little bit of stabilization over the last year or two, and that's a positive sign because it does mean that you have this echo boom coming into the workforce finally after moving out from mom and dad's basement. And you are seeing more of a rebalancing in the United States workforce. Importantly, the unemployment rate continues to come down. We'd like to see that unemployment rate remain down as the participation rate increases. But those are two things that are often talked about in the same breath, but we're talking about two very different underlying causes. On one, the unemployment rate, you have the business cycle, which has improved. And on the other, you have the participation rate, which has stabilized, but that's a longer term secular story. So now the other concern is, well, the unemployment rate is now near its lows of where you could reasonably expect it to get. For the longest time, the Fed had a 5% target on the unemployment rate. Now, what we'd like to see is that stay low for a while, and we'll continue to watch that as a sign of the economy. And the next chart just shows you the last 17 years. It kind of zooms in on that period of time. And again, since 2011, really, we began to see a decline in the unemployment rate. And then since, again, that end of 2015, beginning of 2016, we're beginning to see that participation rate stabilize. And we'd like to see more of that. Now, unemployment is the first mandate for the Fed. The second mandate is price stability. The price stability mandate has been interpreted to mean 2% annual inflation. And for all the jawboning and the frustrations with the Federal Reserve, they have actually kept the mandate fairly well over the last 4 or 5 years. It seems incredible to me that 0% interest rates are warranted. In the United States, it seems we should expect higher interest rates and higher growth. Nevertheless, we have seen a period of very low interest rates, and yet we have seen price stability at the same time. We haven't seen the hyperinflation that many expected a few years ago. The orange line on this chart strips out food and energy. Now, of course, none of us buy food or oil. I'm kidding. But because those are volatile, it is often taken out when you look at inflation data over a longer period of time. And so if you look at that orange line, it's been relatively stable. And in fact, after a pickup in inflation due to the stability of oil prices in, again, 2016, you have seen a little bit of a pullback here in the last few months. The ISM price index is another measure of prices. Here we see manufacturing versus services. Of course, manufacturing inflation is going to follow energy because energy is an input to a lot of manufacturing outputs. So the ISM price index, not surprisingly, dropped dramatically in 2014 and 2015 before rising and recovering in 2016 and 2017. Now it's corrected a bit. Services has been much more stable at right around 50. Above 50 is an indicator that there's expansion in prices, and below 50 indicates that there's contraction in prices. Similarly, the ISM Manufacturing Employment Index measures manufacturing employment. It's fairly self-explanatory. And again, you see how the oil correction and the energy price correction affected the employment in the manufacturing sector of the U.S. economy. Again, you saw an improvement even before Trump was elected. But we don't want to discredit the Trump bump. There was something to that, but the underlying trend was already favorable when he took office. And you can see this especially in the next slide, where we zoom in and isolate that June 2016 time period. Once again, the bottom was 46.2 in January 2016, and since then it's had a nice rise. And our last reading in June had a very healthy pickup from May, and it's now above 57, which is a very good level for the manufacturing employment index, and is a sign that there's significant recovery in that sector of the U.S. economy. Part of that reason is the U.S. dollar index. A strong dollar is bad for the manufacturing sector because it means that our exports are more expensive for other countries. We have to pay our employees with a strong currency. Whereas a weak dollar is good for the manufacturing sector because we get to pay our employees with a weak US dollar relative to other countries. So we can actually sell the product while still making the same margin for less in Japan or Europe or the UK, and still make the same margin but sell it at a lower price. And what we saw in 2014 and 2015 was not only did we have a weaker oil price, but we also had a dramatically strengthening US dollar. And that also hurt the U.S. manufacturing sector. That has stabilized. It's stabilized over the last 2 years. And in fact, we could be, and we'll get to this a little later on, but we could actually be weakening back down, which would also help the manufacturing sector. That has translated into very strong improvement in the Dodge Construction or Dodge Momentum Index. Now, this is an index that a lot of materials companies use, companies that sell aggregate, because it is a sign of what businesses are doing in terms of construction expectations. A stronger Dodge Momentum Index indicates stronger expectations for building, construction, highway development, housing development, etc. So that's an important indicator, and although it's been volatile, you can see that the trend has clearly been high towards higher levels. Now again, we do get into that same category. Well, look at the level now. We're at or around 150. That's where it peaked back in 2005 before it had a long decline downwards. And admittedly, that is a cause for concern. Nevertheless, we're not seeing an indication of a rollover just yet. Moreover, notice that the peak was in 2005. It experienced 2 years of declines before it really hit the equity market. So it's a leading indicator in some instances. So just be wary of that. And in terms of the Institution for Supply Management, they also come out, not only do they have employment data and price data, but they also have new orders data. And you see that both for manufacturing and for services, we've seen an important pickup again in that May-June time period from 2016. Little wonder then that we had a strong equity market rally since that time. Importantly, the CapEx forecast. This is what people are spending on large capital expenditures like Caterpillar tractors, or John Deere equipment. And that's improved dramatically since 2016 and 2017. The Philadelphia Federal Reserve and the Richmond Federal Reserve both put out estimates. They go around and take surveys. And it does appear that companies are getting ready to spend. The CEO confidence has improved. And Andrew's going to actually talk a bit about how the consumer confidence has improved as well.
Thanks, Ben. Consumer confidence, I really think, is at something of an inflection point. That may sound odd looking at this chart, because if you look at it, it'd be easy to say, well, we had an inflection point, in late 2007, and shortly thereafter we had a decline. And then we had another inflection point in 2009. So understand what I'm saying here is not so much that we are due for a change, but rather we are due for something of a reckoning with how we are perceiving this data. That may sound a little bit odd, but what I mean is this. If you listen to a lot of the news headlines, whether it's market-specific resources, things like the Wall Street Journal or MarketWatch.com, you read a lot about how people are still kind of itching for a crash like we had in 2008. People are still very much worried about it, despite some of the data that we've already gone through that has obviously strengthened since that time period. You read those headlines. I know sometimes we even talk to clients who feel like 2008 was just yesterday, despite the historically long run-up of this market that we've already talked about. Consumer confidence has rebounded, and I think there's a couple ways you could interpret this data. The first would be to say, oh, well, this makes sense. It's basically tracking the market. And I don't think that's necessarily a wrong interpretation. I do think where we get into trouble is to say, well, this is tracked a market that surpassed the highs of 07 and even into 08. And we are now at a confidence level that is mirroring those highs or even a little bit higher. Therefore, we are due for a pullback. I don't think that's the correct interpretation of this data. Yes, confidence has rebounded. It's rallied quite nicely. I would expect, given what we've seen with unemployment, with jobless claims, with wage growth, with the stock market itself, I would expect that confidence would be a lot higher than it was in 08 and 09. And that's exactly what we see. Now, is it completely irrational? That's up for debate. I don't think our view is that it is. When you go back and you look at some of kind of the dot-com euphoria, which you can see on this chart, really in the early 2000s, that's a little bit more questionable. But I would argue that the economy is on stronger footing, and this consumer confidence is not just relative to 08 and 09. It's actually relative to what's happening today, which I think is an appropriate thing to be looking at. A number of factors that other people look at when they're looking at this are really things like autos. You hear a lot of times that autos are a read-through to the economy, and it makes sense in a lot of ways. I mean, you can think about the role of a car in a couple fronts. Number one, obviously, when people are purchasing cars, that means they have the money to spend, or at least the credit worthiness to borrow and obtain a vehicle. The other way to think about it is from a manufacturing standpoint. I don't know if you can, but I can't build my own car. So if I buy a car, that's lending credence to the idea that someone manufactured it. And if a lot of cars are being purchased, then that kind of gives you an idea of what the economy is doing from both the purchasing side and the manufacturing sides. There's a really popular argument right now that says that we are at quote-unquote peak autos. Autos are at an all-time high. We're never going to see autos, go any higher than this. Look at where it is. And we're even seeing a little bit of a pullback from that peak. If you look at kind of the tail end of this chart, we're seeing a little bit of pullback from where we were maybe in, earlier in 2016. The reality is that there's a number of other factors going on here, not the least of which is the fact that there's a general upward trend. We talk a lot about the stock market. It trends upwards. There's ups and downs within it, but it trends upwards. It would make sense that the United States economy would be purchasing and owning more vehicles than it was in, say, the 1940s or 50s, just given where we are on the affordability of vehicles as well as the amount of income people have at their discretion. So, yes, we are trending upwards. I would expect that autos will continue to trend upwards. So I think reading in to this data at too deep of a level is a little bit of a challenge here and could maybe give you a distorted view of this. You'll see this all the time on Twitter feeds and kind of the quick blog posts and headlines. Peak autos and the concern that presents not only for companies like Ford or General Motors, but for the economy. We're pulling off this all-time high in autos. You can see that at least in a short term, but it's really hard to identify this as something that's truly a negative leading indicator moving forward for the economy. Another thing with vehicles is really this idea of used car values, and you kind of hear about what they're doing and what the prices of a used car actually are and what the market is for those. And we actually see some pretty solid strength here on this chart, and you can see that. I do think there is cause for concern for autos. I think there's a very real challenge ahead with all the vehicles that are coming off of lease. When you think of not only the large corporation that have a fleet of leased vehicles, but also all the rental car companies that are facing challenges kind of in their very core business model and how they're going to survive. Those cars are going to hit the market at some point. You're going to have a flood of inventory. And that is a very real challenge that needs to be dealt with on the auto side, especially on the resale market for autos. But again, is that something that I would say, oh, this is going to trigger, the downfall of the economy, or this is a read through to say the economy is, at its top and we're due for a pullback? I just don't think that's appropriate. Moving forward, a couple of other things that we kind of look at is housing. I mean, housing is such a hot button issue ever since 2008, and for good reason. I think it's interesting looking at this. When we look at market crashes, it's very rarely that you get the exact same thing. And if anybody says, hey, we are poised for another version of 2008, or here comes the Great Depression all over again, anybody that's doing that is at a minimum being a little bit unearnest in their analysis, because we rarely get crashes that are a reflection of the exact same contributing factor. So I think people that are really starving to say, look at homes, look what's happening with those, whether it's prices, new home builds, first-time home purchases, whatever the metric may be, anybody that's pointing to that and saying, look, we're due for '08 all over again, is being a little bit naive. Again, if everyone could just follow one specific trend and predict the next crash, there probably wouldn't be a next crash. If we were able to all say, well, hey, when home prices do this, or when first-time home buying numbers do that, that's when bad things happen, we'd all be able to kind of avoid that. But it's rarely the exact same thing that kind of triggers this. So here we're looking at new single-family homes sold. Obviously, you're seeing really great growth since '08, and that's, I think, a chart that a lot of people like to zoom in on and say, look what's happened over the last 9 or 10 years. Look how high we are compared to those lows. But again, is that the norm? Not necessarily. You actually have us right now almost getting back to where the home market was in 1995. And again, you could say, well, that was another big run up. But if you look at the data here and the frequency with which we have been higher than where we are now, it's the vast majority of the last 22, 23 years. So that context, I think, is really important as you're keeping an eye on some of these factors. Another thing a lot of people look at is delinquency rates. This became such a big kind of hot button issue, especially with major publications, both in book and movie form, like The Big Short, kind of this idea of look at how many people can't afford to actually pay off their consumer loans, whatever the composition of those loans may be. And again, I think we're in perfectly healthy, if not low levels. You look at this, and obviously you had a large spike in '06 and '07 and '08, and that prolonged into '09 and even 2010, which makes sense. When the economy crashed, people lost jobs. People who maybe previously were not under the threat of going into delinquency suddenly were, because they lost income. So you had a little bit of a prolonged period in which this was really hyperinflated. But we're nowhere near that. Again, you could look at a really small snapshot of this data and say, oh my goodness, delinquency rates are on such a huge rise from where they were in 15 and 16. They're up a tick, but historically speaking, again, not even to where we were in the late 80s, certainly not where we were in the early 90s or even the mid 90s and early 2000s. So again, delinquency rates, add some context there. Don't just get consumed by the last year or 18 months of data and say, well, this is really on the rise. It may be rising. I would argue that there's room for it to continue to rise without really threatening the economy. Or we may be sitting here a year from now saying, yeah, we had a little bit of a blip there, and there may or may not be an explanation for it. Again, similar story here, and I'll go over this relatively briefly. Another place where people really like to look at kind of that short-term data is when we're looking at household debt to disposable income. There's a lot of factors at play here, and this is always kind of the thing where you see a headline about, the amount of household debt, and people almost kind of write from a tone of outrage. They're so unbelievably offended about how much debt there is. They're just absolutely stunned by this. But you can look here. This is a really long-term trend, and it's interesting. It directly coincides with the narrative of lack of American financial responsibility. I mean, we hear so many people bemoaning the fact that personal finance isn't taught at a high school or collegiate level. We hear so many talk about, young people, they don't know how to budget, they don't know how to manage their finances. Well, that's probably true in a lot of cases, and that lends itself to this chart as you've seen this basically trend upwards. But again, the amount of debt relative to income is not at a staggering high. It's actually continuing to decrease from where it was in '06 and '07. And you could say, well, it's decreasing at a slower rate, so the rate of change is kind of flattening. That's true, but at the same time, again, are we really panicking over what's happened over the last year or two, given all that we know about what the economy is doing? Not necessarily. To some extent, this is indicative of possibly consumer confidence. People are more confident buying things. People are more confident taking on a little bit of debt. You would like to see this stabilize, and obviously we would like to see it decrease. I think that'd be a really great leading indicator of personal financial responsibility, and that would be a really positive thing for us to see as individuals as well as a company. But are we panicked about where this level is right now? No, not really. This is really where this level has been for the last 16, 17 years. And you could make an argument that that's way too much debt. And I think certainly on a personal level, you could, kind of examine your own situation and do that. But to say that we're going to look at this collection of data and draw any conclusion other than it's declined significantly over the last 10 years, I think would be a little bit of a false interpretation.
And this is Ben again. And Andrew was talking just now about the improvement in the household debt to disposable income ratio, and part of that's just due to the improvement in wages. Now, we're not having the explosive wage growth. I mean, if we could get back to that 5% wage growth that we had in the early 2000s, late 90s, or even late 2000s before the crash, that would be fantastic, but we're not there yet. In fact, for the two charts you see, the two lines you see on the graph here are the wage inflation for people who stay at their current job and the wage inflation for people who switch jobs. And again, what we see is that a leading indicator of the strength of the economy is when job stayers get paid less in terms of inflation than job switchers. In other words, you get paid more on average if you switch jobs than if you stay at your job. And that I think is a leading indicator for wage inflation, which is a good sign for the economy. And in this next chart, you can see the spread between the two, which is the premium to switching from your job. The solid line is a 5-period moving average. And we just use this because the data is quite noisy. And that's about between 50 basis points or half of 1% and 1% over the last year or so, which is a good sign for the economy. If that were to move down materially, like it did in 2007, like it did in 2000, then we would begin to have more cause for concern. Switching gears a little bit now, I want to hit on the sector analysis, because what we want to do in this webinar is really illustrate what we're seeing and how that may correlate with what you're seeing in headlines, or how that may disagree with what you see in headlines. Now, this chart is quite noisy. You can pause it. You can download the slides if you'd like. But what I want to focus on is this, specifically the difference between department stores and non-store retailers, because this is where the fight is happening in retail at the moment. And this is a huge story with Amazon coming in. Now, this is as a portion of the consumer budget, non-store retailers now take up about 7.7% of the consumer budget. Back in 1992, that was 2.7%. And if you really look at the numbers, what you're seeing is not a flatlining of growth, but an acceleration of growth and an acceleration of decline in department stores. And that's important because we've seen the chaos in retail, especially in the last year or two, and that is borne out by the data. A lot of times the fundamentals, when you really dig into it, do track the stock prices fairly well. So for people who are decrying the rise of Amazon and the Amazon share price, there's actually good reason for it now. Full disclosure, we did not have enough Amazon over the last couple years. Nevertheless, this is what the fundamentals are showing. We will update this chart when we have the 2017 data as well. In terms of the last few weeks and what has been performing well year to date, you can see that financials have lagged. So if you look in the quadrants, in the bottom left quadrant, you see very weak telecom and energy. And telecom may be improving a little bit. You want to see them move from the third quadrant there to the first quadrant. Financials are beginning to improve. Technology is still leading, but potentially weakening us just a little bit in the last few weeks. But still, the dichotomy between the technology sector and old boring stuff like telecom and energy is particularly notable year to date. And you can see that in the breakdown. The volatility in the energy sector is extremely high. And as we talked about earlier, volatility is negatively correlated with returns, which means higher volatility, lower returns, usually. Lower volatility, higher returns. And what you can see is energy stocks have been very volatile. What I want to bring out, though, is the fact that telecom stocks have relatively low volatility and technology stocks have relatively high volatility. That's not a surprise because you would expect technology stocks just to have higher betas, which mean they have higher sensitivity to the market. Nevertheless, if you look at the next slide here, technology stocks have outperformed dramatically year to date. Healthcare has done well, and telecom has lagged. So that's an interesting opportunity and potentially means that telecom stocks may have a bit of a recovery. There's a secular story there with the arrival and competition of guys like Comcast and a lot of the cable companies trying to compete for the same market. But they could be approaching a level now which is fairly attractive. And then the energy sector, of course, lagging. And after a strong rally, end of 2016, into the $50 range per barrel of oil, we've now fallen back into the mid to low 40s. Moving to the international side of things, I want to start on currencies. And we brought up the dollar index earlier in the presentation. Here is another way of essentially showing how the US dollar has fared over the last year. So the euro has strengthened, has rebounded since it declined dramatically after Trump was elected, and then has since rebounded and is now at quite high levels relative to recent history. The improvement in Europe is continuing. Just a few months ago in 2016, the German 10-year Bund had a yield in the negative percent range. And what this means is that, in the United States, if you lend money to the government, you can expect a 2% or 3% annual return. In Germany, the German government could lend money to you, and you would have to pay the German government for that right. That's because of deflation. But that has changed. And in fact, the German 10-year Bund yield now is over 50 basis points, and it's broken out of that range after it was pressing there. So we could be setting up for a bottoming in German Bund yields, which could also translate to an improvement in United States 10-year yields, which remain mired in this range of 2% to 2.75%. I do think if you go back to the inflation charts we presented earlier in the presentation, I do think you'll need a pickup and acceleration in inflation in order to see materially higher and durable interest rates, especially on the 10-year yield, even while the Federal Reserve continues to raise the short end of the curve. Next slide here is the Citi Economic Surprise Index. Now, this measures where the economic data comes in relation to the consensus economic forecasts from Goldman Sachs, from Citigroup, from JP Morgan. And you can see that the economic data continued to surprise the consensus estimates through the beginning of this year. And again, you see in early 2016, this kind of hit this inflection point of surprises. Now, in March and April timeframe, that changed dramatically. The economic forecast began to get much more bullish, And the data began to slow down a little bit. That's kind of what tends to happen in these sort of things. Now, does that mean the market's going to crash? I mean, we're not going to speculate on that, but it does mean that the economic forecasters have caught up, so to speak, to the actual economic data. Now, here we've added the British pound in orange, we've added the Euro surprise index, and we've added the Chinese surprise index, and the Chinese is in gray. And none of them are as bad as the United States, but all of them have fallen back since that March-April timeframe. And that's worth noting as we look to what GDP is going to do and what inflation is going to do. In the United States, we're expecting the economists are expecting a pickup in real GDP. And if you notice, that is aided in large part due to private investment. And this goes back to our CapEx charts at the beginning of the presentation. Inflation, importantly, should remain fairly stable after accelerating to 2% or thereabouts. In the Eurozone, once again, we see stable to modest, very modest GDP growth. But importantly, if you look down at the price index, the CPI is expected to normalize it in the mid 1% range. That would be a dramatic achievement for the ECB, the European Central Bank President Mario Draghi, who said he would do whatever it takes to take the inflation rate back to what he views as price stability, which is in that 2% range. In China, the data can be manipulated. It is manipulated, but what we see is that general slow glide path from about 10% GDP growth to now 6% GDP growth. And you say, well, that's not good. This is still 6% GDP growth. Bear in mind, we have 2 to 3% GDP growth. So that's a solid improvement in the Chinese economy, even if it's 4% in actuality. And importantly, although we're seeing a bit of a deceleration, it's not a dramatic fall off. We haven't seen that hard landing yet. Shifting gears to commodity markets, the commodity space has been under intense pressure. We saw a huge run up in crop prices during the 2011-2012 drought timeframe. And since that time, they've fallen back and have been mired in this low range. There has been some signs of stabilization, but we can't really say that they're rebounding. So this is a chart of soybeans in orange and corn in gray. And it's just continued frustrations for the American farmer. Good for American consumers, though. Cheap food. But all commodities are depressed. In this chart, we have gold and we have oil. And you can see the declines in both commodities. And there has been a stabilization in them, but not really a pickup and a recovery, which begs the question, well, what is actually normal? Is normal what we see now, or is normal the elevated levels of a few years ago? And that's, again, up for debate, and it's difficult to speculate on that because it's so much driven by manipulation in oil markets by OPEC and the cost reductions in American fracking.
And this is Andrew back again. A thing people commonly look at when they're trying to diagnose, the range of the market, specifically on the equity market, is really looking at price to earnings. The idea being, hey, whatever a stock's share price is actually trading at should in some way reflect the amount of money that the company is generating. Therefore, let's project how long it would take, for instance, for this company to earn that amount of money. Now, that's the PE ratio. If you're listening to this webinar and you've made it this far in, you probably already knew that. But it's a great way to kind of take a look at things. But when you hear people talk about quote-unquote peak PEs, so these high PEs, this is really what we're looking at. And you certainly can make a case that these PEs are on the high end. And in fact, I think we would agree with that argument. These are not historically low PEs by any stretch. If you go back just a couple years ago, you have PEs that were lower, but you can also see that there's a lot of movement, and a lot of movement relatively quickly in these scales. And if you look at the peaks that you see, 85 to 89, then again in that kind of early 90s, all the way up, you also start to realize that these are not necessarily directly correlated to market pullbacks, nor are they necessarily indicative of market rallies to come. So we're keeping an eye on that. We really tend to focus on that on an individual company by company basis from an investment standpoint, which may not be the most relevant point to make during a macro presentation, but we tend to look at what is an individual company's valuation looking like, and not just on a PE level. But this is something to pay attention to. Obviously, as it does go higher, it does tend to lend itself to a market that's being overvalued. This, I think we would argue, is probably a market that's on the high end of fair value, but I certainly wouldn't say that this is one where we feel like these valuations have just run away. And again, PE is a little bit of a simplistic view of valuation to begin with. The next two slides are actually going to look pretty similar, so I'll try not to go back and forth too much, but you may want to pause here and kind of review these things. But the first slide is actually showing operating margins. And so this is something we tend to look at just in terms of how is the economy strengthening, is there pricing power, what are people paying for whether it's a good or service. You can get a lot of read-throughs just from this specific data. And as you can see, operating margins, they're strong, and this is a look at the S&P 500. You're seeing strong operating margins. You see that in 2017, they're stronger than they were in 16, stronger than they were in 15. At the same time, these are not necessarily operating margins that are staggeringly high. We're not necessarily alarmed by their height. Not only that, but you tend to see the tail end of market is often defined by declining operating margins. So, with that in mind, you could make an argument that, well, in 2012, we strengthened to 13, we saw a pullback in 14, pull back even more in 15, you could actually make a case that would be a little bit more alarming. But we rebounded in 2016, continuing to see some expansion there. So again, we view this as a relatively positive sign for the economy, but we say that even with a little bit of trepidation, acknowledging that yes, they're high. Similarly, looking here, we've got return on assets. Again, you're looking for stability. That's what we're hoping to see here. But you're not necessarily seeing anything that's really running away on this. As you look at these, you can obviously see the troughs and you can see the challenging markets. Here, when you start to see these longer, taller gray bars, that's the stability that you're looking for. That's the strength that you're hoping for. And again, we're still very much in that realm. The very last thing we're looking at right now, at least on this portion of the presentation, is just the likelihood of an interest rate hike. And this is some projections that we pulled straight from Bloomberg. So you can see that there, and you can kind of see when people think we're actually going to see a hike. What's interesting here is the probability of a cut. If you look at kind of that third column, first column shows the meeting date. Second column shows the probability of a hike. Third column, probability of a cut. Obviously, no one is expecting that, but you don't have to go too far back to hear a lot of economists making a strong case, at least in their opinion, for a rate cut or continued low rates. Meanwhile, you actually see some solid calls for a rate hike. You can see we've already had a couple this year, but as you look at September, 10% think there's going to be a rate hike. As we continue on out, most people expect that there will be another rate hike by a year from now. So you can see that kind of based out there and forecasted. And again, when you think about what the Fed is mandated to do, and we've already touched on those items, that's a call to the strength of the market. When the market is struggling, when unemployment is too high, when core inflation is not doing what it should do, those are the types of things that make you think, maybe we don't need a rate hike. But the general consensus is that we're going to expect to see one. And you can even see kind of going on out how much that rate is expected to move by some economists. Again, straight from Bloomberg there.
So quickly to the summary slide here to bring it all kind of back together. And on the international side, we're seeing growth becoming clearer, especially in Europe. Commodity countries are under pressure, and they've been under pressure for a while. There is some stabilization, but if you have an export-driven economy that's based on a low value-added good, you're still well below where you were a few years ago. That said, the enthusiasm with the international economies might mean that the near-term move is overdone. We are seeing some correction in the economic surprise indexes. The currencies of those other countries are really strengthening relative to the US dollar, and the calls are for those to continue. Sometimes when the calls are always in one direction, you have to start thinking about the other side of things. So think about the other side when you look at the international expansion of the last year or so. Importantly, you are seeing a relatively stable inflation picture for the first time in a long time on the international front. There's some noise around energy, but stable pricing is very important as far as the central banks are concerned for international economies.
And this is Andrew again. Ben and I are just going to pass the mic back and forth on this like the Beastie Boys of finance. But recapping some of the things that we're seeing specifically in the United States, we are seeing that the U.S. is a little bit ahead of Europe. And I don't think that's necessarily something we would say specifically just to right now, second quarter of 2017. The reality is the United States never really quite got to where some places in Europe did over the last couple of years. A great indicator of that really is interest rates. We did not have negative interest rates. We were not really threatening to have negative interest rates. Interest rates didn't go to zero. So in some regards, it's not so much necessarily that we have recovered significantly quicker here domestically, so much as I think it is maybe the trough wasn't quite as deep. But nonetheless, we are a couple years ahead when you're looking at things like inflation and growth of the economy. Business investment is rising. Companies are starting to spend money on major projects. We're also seeing similar trends upward on consumer confidence. So when you start to see businesses spending money and you start to see consumers spending money and they're feeding off each other like that, that tends to be a positive trajectory. The manufacturing economy has improved. There are, again, concerns about autos. I talked about that just a little bit ago. And the biggest concern there is really to kind of keep an eye on those leases that are rolling off and seeing what that actually does for the manufacturing portion of that industry. So certainly something to keep an eye on, but there's still some reason to believe that we're not necessarily at the peak there. And then there's a lot of runway on other major industries such as housing. There's a good bit of growth left there as we saw looking back at those charts. Wage growth is picking up. Short-term interest rates are rising ever so slightly, maybe not quite as quickly as some would expect if you look at a historical context, but nonetheless, the Fed is raising rates again. Wage growth is picking up, and we looked at that data both on job stayers and job movers, and there's a lot of things to be optimistic about within the economy.
It's Ben back on the mic, just wrapping up. So what does this mean for your investments? So valuations are not cheap. I mean, they seem relatively, and if you look on a baseball innings basis, maybe we're in the sixth, maybe we're in the seventh inning. It doesn't seem to us like we're in the ninth inning. We're not seeing the imminent concerns for a dramatic market collapse. Can there be corrections? Of course. But as far as a significant pullback on the scale of 2008 or even 2000, we're not seeing that in the valuations or the fundamentals at the current time. That said, if you look at various sectors, the relationship between volatility and returns is incoherent. As you look at the volatility in technology, correlate that with the volatility in telecom, and the returns are different. Now, secular trends toward e-commerce are accelerating, which is a pressure for retailers, traditional retailers, and that will continue to be a pressure. The winners will be the ones who can adequately make that shift and become strong in e-commerce. Because consumer balance sheets are sound, incomes are rising. So what does this mean for opportunities? Well, enabling technologies. If companies are going to invest in CapEx and they need to improve their tech infrastructure, then companies like Oracle might do well. Companies that supply capital equipment to make other companies run efficiently. Also, as Andrew mentioned, housing is potentially a point of opportunity. On the other side, concerns are just the continued weakness in commodities and what that means for the countries there and the companies that rely on commodity prices. You're also seeing some volatility in technology stocks. You are seeing potential overvaluation in some of those companies, and you're seeing potential for a rollover in the automobile sector. And as we said, we don't think that necessitates a dramatic downturn in the overall U.S. economy, but it could have isolated impacts where autos are manufactured.
We appreciate you being here. We'll be back next quarter with another macro look. Thanks to Ben for joining us for this presentation. Ben is our senior equity analyst and is doing a really great job. Make sure you check out all of our content. We do a lot of other podcasts and video stuff through Tusk Media, which is a subsidiary of Narwhal Capital Management. You can find all that stuff on YouTube. So youtube.com/Tusk Media LLC. We also have a couple social media feeds that are basically the same URL. So twitter.com/Tusk Media LLC and facebook.com/Tusk Media LLC.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.